What happens when you take $200,000 and spread it across 5 Fidelity index funds? Build it one way, and it pays you $6,273 a month for life. Build it another way, same $200,000, same 5 funds, and the account grows into almost $13 million. Same money, same funds, two completely different lives. Here's exactly how both get built. John's the one asking himself this question. He's gone through just about every index fund Fidelity offers, comparing them the way some people compare car reviews late at night, more nights than he'd probably admit to his wife, and he keeps landing on the same 5. There's a reason for that. Every portfolio worth building has a few jobs that need to be filled, something to anchor it, something to grow it fast, something reaching for the companies that aren't big yet, something paying real income, and something betting on the parts of the world everyone's written off. 5 jobs. And these 5 funds handle them. Quick thing before we get into them, in case you're newer to this, an index fund is just a basket of stocks that follows a set rule. Nobody's sitting there picking winners and losers. The fund owns whatever's in the index it tracks, and that's it. That's why these things cost almost nothing to own, and why they tend to work so well if you just leave them alone over the long term. John starts with the one that holds everything together, the boring one, FXAIX, the Fidelity 500 Index Fund. This is the anchor. It tracks the S&P 500, basically the 500 biggest companies in America in one fund. When someone says the market was up today, this is basically what they mean. The names inside are exactly who you'd guess: Nvidia, Apple, Microsoft, Amazon, Meta, and it leans heavy on tech, more than a third of the whole fund. John picks this one first and doesn't think twice about it. If you're building anything at all, this is the floor you build it on. One quick note before the numbers, because we're about to use the word dividend a lot. A dividend is just a slice of a company's profits paid back to you for owning the stock, usually every 3 months. Own more shares, get a bigger check. FXAIX runs a 1.06% dividend yield, a 6, 84% dividend growth rate, and a 13.54% annual share price appreciation. That appreciation number becomes the steady engine the rest of the portfolio gets measured against. The core gives John all 500 of those companies at their normal size. Everyone treated the same. But a handful of those names have been pulling most of the weight lately, and the next fund John picks leans right into them, the Fidelity Nasdaq Composite Index Fund. If FXAIX is the anchor, this one is the engine. It tracks the Nasdaq Composite around 3,000 companies, packed with tech. Quick bit of context. Because this one trips people up. The NASDAQ isn't a company, and it isn't really a fund either. It's a stock exchange, a place where stocks get bought and sold, and it happens to be where most big tech names list themselves. So any fund tracking it tilts hard toward tech. Some names overlap with FXAIX, Nvidia, Apple, Microsoft, but the weights tell a different story. Nvidia alone is more than 11% of this fund. The top 10 holdings make up nearly 59% of the entire thing. You're not getting 3,000 companies spread evenly. You're getting a heavy bet on a few tech giants with a long tail trailing behind. John adds this as his growth play, and the reason comes down to one number. FNCMX runs a 0.47% dividend yield, a 6, 91% dividend growth rate, and a 17.95% annual appreciation, the highest of any fund in this entire video. That's the upside. Just know that concentration cuts both ways. When big tech runs, this fund flies. When big tech takes a hit, this is the one that feels it first and feels it hardest. FXAIX and FNCMX have one thing in common, though. They're both built out of giants, companies that already made it, which leaves an obvious gap. Where's the growth that hasn't happened yet? FSSNX, the Fidelity Small Cap Index Fund. Let me read you a few of its top holdings: Bloom Energy, Core Mining, Fabrinet. If you've never heard of a single one, good, that's kind of the point. It tracks the Russell 2000, about 2,000 small American companies, too small to make it into the S&P 500. Unlike FNCMX, nothing here is a big bet. The top 10 holdings add up to under 6% of the fund. It's 2,000 little shots on goal spread thin. The idea is simple. Every giant inside FXAIX was a tiny company once, too. This is John's bet that a few of these names become the giants of the next 30 years. Run the numbers and you get a 0.89% dividend yield, a 7.44% dividend growth rate, and a 9.6% annual appreciation. Now, I've got to be straight with you here, because the numbers don't tell the story you'd expect. Small caps are supposed to be the high risk, high reward slice, the rocket fuel. But that 6% is the lowest we've seen so far, lower than both big US funds. Small companies have actually trailed the giants for years. So why hold this one at all? Not because the track record wins, because it doesn't. John holds it because it's the one corner the other four funds can't reach. The small stuff before it's big. Not a sure thing, a bet made on purpose. And that's the whole American side of the portfolio, the biggest companies, a concentrated bet on the best of them, and a flyer on the smallest ones. But here's the problem with stopping there. Every dollar is still riding on one country, and no country leads forever. The US has had a brutal decade before where it went nowhere for years, while the rest of the world kept moving. Putting a piece of your money outside America isn't betting against it. It's making sure your whole plan doesn't depend on one country winning every decade. For this, John goes with FSPSX, the Fidelity International Index Fund, and this is the one that genuinely surprised him, because the highest paying fund of the five isn't American at all. FSPSX tracks the MSCI EAFE, a fancy way of saying developed countries outside the US, Japan, the UK, Germany, Switzerland, Australia, established economies, big stable companies. Names you half recognize: Nestle, Roche, AstraZeneca, HSBC, plus ASML, a Dutch company most people have never heard of that builds the only machines on Earth advanced enough to print a modern computer chip. They don't make the chips, they make the machine that makes them possible. It's also worth noting this fund runs an expense ratio of about 0.03%, next to nothing to own. FSPSX does two jobs here: income, and we'll get to exactly how much in a minute, and insurance. If America hits a rough patch, this part of the portfolio doesn't go down with it because it isn't tied to the US at all. Here's where it earns its spot: a 5.8% dividend yield, more than triple the next highest fund in the lineup, a 6.85% dividend growth rate, and a 7% annual appreciation. Sit with those numbers for a second, because they pull in two directions. FSPSX pays the most of any fund here, while it grows the account the slowest of any fund here. Developed International has lagged the US for well over a decade. So you've got the best income and the weakest growth living inside the same fund. Hold that thought, because it's the exact tension the back half of this video runs on. Developed International hands John income and stability, but those same slow, steady economies leave one last piece: the part of the world still on its way up, FPADX, the Fidelity Emerging Markets Index Fund. And this one's a flat-out contradiction. It's been one of the worst performing corners of the market for about 10 years running, and it has the fastest growing dividend of all five funds in this portfolio. Both are true at the same time. Emerging markets just means economies still growing into their full size. Taiwan, South Korea, China, India. About 80% of this fund sits in Asia, and it's top-heavy in a way worth seeing. Taiwan Semiconductor, the company that takes machines like ASML's and actually manufactures the chips, is more than 14% of the whole fund on its own. One company on one island carrying a seventh of everything here. After that, Samsung, SK Hynix, Tencent, Alibaba, all giants, none of them American. Worth noticing, Nvidia anchored the American fund, ASML showed up in Europe, and now Taiwan Semiconductor here in Asia. Chip makers are propping up every corner of this portfolio on every continent. John's reason for holding this one is the dividend growth, FPADX lands at a 1.91% dividend yield, an 11.01% dividend growth rate, the highest in the entire portfolio, and a 7.71% annual appreciation. So that's all five: an anchor, an engine, a wild card, an income pair, and a long shot. But here's the part most people get completely backwards: picking good funds. That's the easy part. Anyone can do it. The decision that actually changes John's life is how much of each one he buys, because these exact five funds can be built two completely different ways. Lean the weights one direction, and this portfolio pays John every single month. Lean them the other way, and it grows into something close to twice the size. Same $200,000, same five funds. The weighting is the entire strategy. Let's build the first one, the version designed to pay him, the dividend-tilted portfolio. Here's how the $200,000 splits up. The biggest slice, 35%, goes to FSPSX, the international fund, $70,000. It's the biggest piece because it's the one writing the checks. Next, 20% into FPADX, the emerging markets fund, $40,000, the long shot. But remember, it's also got the fastest growing dividend of the five. So in an income portfolio, it's the piece that grows the paycheck over time. Then 20% into FXAIX, the S&P 500, another $40,000. The quality anchor keeping everything grounded joint, 15% goes to FNCMX. The growth engine, $30,000. Because even in an income build, John wants some real growth so the account doesn't stall out. And the last 10%, $20,000, goes into FSSNX, the small cap wildcard, the smallest slice. Because in a portfolio built to pay you, the long shots stay small. Here's something that flips how this looks. Add up the American funds FXAIX, FNCMX, and FSSNX, and they come to 45% of the portfolio. The two international funds are the other 55%. This isn't John turning his back on America. It's him letting the higher paying side of the world take the lead while almost half the money stays home. Put those five weights together, and this portfolio comes out to a 2.78% yield, a 75% dividend growth rate, and a 10.35% annual appreciation. Here's what that's projected to actually do. After year one, the $200,000 is projected to grow to $226,272. Nothing wild yet, give it 10 years, and it's projected to reach $668,839. By year 20, projections have it at $2,125,315. And by year 30, this portfolio is projected to reach $6,492,396, paying John $75,282 a year in dividends. That works out to $6,273 a month, every month for the rest of his life. Here's what makes that different from just selling off stock to live on. He doesn't touch the account to get it. The $6,273 is the dividends being paid out on their own. The shares stay invested. The account stays whole and keeps growing. The money just shows up. Of the roughly $6, $29 million this portfolio is projected to add on top of the original $200,000. About $5.45 million would come from share prices rising over time. The other $839, 0 cents or so, would come from dividends being reinvested along the way. That word reinvested is doing a lot of work. Every time a dividend gets paid, instead of pocketing the cash, John uses it to automatically buy a few more shares. Those new shares pay their own dividends, which buy more shares, which pay more dividends. Stretch that loop over 30 years, and it turns into a snowball. But that's only one way to build it. And John knows there's another version of himself watching this, one that doesn't care about the monthly check, one that just wants the biggest possible account at the end. So what happens when he takes those exact same five funds and weights them in the opposite direction? Same five funds, brand new weights, and they look almost nothing alike. Half the entire portfolio now, 50%, $100,000, goes to FNCMX, the growth engine. That 17.95% appreciation was the highest of the group, and this build leans on it as hard as it possibly can. 0.25% goes to FXAIX, $50,000, still the anchor, Just bigger this time, 0.10% goes into FSSNX, the small cap wildcard, $20,000. The same long shot for extra upside, 10% goes into FPADX. Emerging markets, another $20,000. The bet still on the table, just sized small. And finally, FSPSX, the fund that was the whole star of the income build, drops all the way down to 5%, $10,000. At this weight, it isn't paying the bills anymore. It's just a little insurance against the US having a bad stretch. Notice what happened to the two international funds. In the income build, they were 55% of everything. Here, they're only 15%. They basically swapped seats with the American growth names. This portfolio is now about 85% American, and almost all of it is built to grow, not to pay. Averaged together, this portfolio runs at a 1.07% yield, a 7.35% dividend growth rate, and a 14.44% annual appreciation. If the goal is the biggest possible number at the end, here's what that's projected to look like. After year 1, it's projected at $231,022. By year 10, projections show it reaching $825,205 a SIV, already pulling ahead. By year 20, 3,285,871, the gap widening every decade faster than the one before. And by year 30, this portfolio is projected to reach 12,862,188 tons, almost $13 million out of that same $200,000. Almost all of that is one single thing: share prices going up of the $12. $66 million this portfolio is projected to add. About $12.47 million would come from appreciation alone. Only about $197,000 of it would come from dividends. Close to 98% pure price growth, barely a sliver from income. By year 30, this portfolio is projected to pay John $14,244 a year. That's $1,187 a month. So John's got two portfolios in front of him, and the one that grew almost twice as big is the one that pays him almost nothing. That's the part that doesn't sit right with him at first. The income build ends at $6.49 million, paying $6,273 a month. The growth build ends at $12.86 million, paying only $1,187 a month. On the dividends alone, the smaller account pays more than 5 times what the bigger one does. But some of you are already running a different set of math in your head, because there's another way to pull income out of that big account, the 4% rule. Quick explanation: the 4% rule is the standard guideline for living off your investments. The idea being you can pull out about 4% of your portfolio every year in retirement, and the account should last you. So let's apply it. 4% of that $12.86 million growth portfolio is $514,487 a year, which comes to $42,874 a month. That's nearly 7 times the income portfolio's $6,273. If your goal is the most spendable cash in retirement, the growth build using the 4% rule is genuinely hard to beat. Now, 4% is just a starting point. A lot of people pull 2 to 3% instead, so the money lasts even if they live to 100. On this account, 3% is still $32,155 a month. The point is, the big account gives you flexibility. So if the growth portfolio can pay that much more, why would anyone build the income version instead? Here's the one thing the 4% rule can't get around selling. That $42,874 a month only exists if John sells off a chunk of his shares every single year. He's slowly drawing the account down to pay himself. The income portfolio's $6,273 works differently. That's dividends being paid out while every share stays exactly where it is. The account doesn't shrink, it keeps growing, and he never sells a thing. That difference matters most the moment the market drops. Say it crashes the same year John retires. With the growth portfolio, he'd be selling shares at the bottom just to cover his bills, locking in those losses for good. There's a name for that risk: sequence of returns risk. One of the reasons people retire with huge accounts and still manage to run low. The dividend portfolio doesn't care what the market did this year. The checks just keep coming. If you're leaning toward the growth build, one fix worth knowing: Keep 1 to 2 years of expenses in cash as you get close to retirement. That way, a bad year doesn't force you to sell at the worst possible moment. It just means you spend from cash for a while and let the portfolio recover. Before we wrap this up, a couple of honest notes. These 30-year numbers are projections built on historical dividend and appreciation rates, not guarantees. The market doesn't move in a perfectly straight line, and your actual results will bounce around that path. And taxes matter more here than you'd think. Dividends paid inside a taxable account are still taxable, even when reinvested. The good news is that qualified dividends are taxed at the same lower rate as long term capital gains 0%, 15%, or 20%, depending on your income, instead of your regular income tax rate. Hold this exact portfolio inside a Roth account instead, and those dividends grow completely untouched by taxes for the rest of your life. Where you hold this matters almost as much as how you build it. So, which one actually wins? Both of them. That's the honest answer. Even if it's not the answer that makes for the flashiest headline, the growth portfolio makes John richer and it can hand him far more cash to live on, as long as he's comfortable selling pieces of it and riding out the timing along the way. The income portfolio pays less in raw dollars, but it never asks him to sell, and it never leans on good timing to work. One version is a bigger pile he draws down over time. The other is a check that shows up every month, while the whole account just sits there, still growing, still compounding, whether he's paying attention to it or not. That's the real decision. Does he want a bigger number he has to slowly take apart, or a steady paycheck that leaves the entire thing standing? If this finally made the difference between dividend investing and growth investing, click for you, subscribe, because we build portfolios exactly like this every week. Real funds, real numbers, no guesswork. Tell me in the comments which one you'd actually build, the $6,273 a month for life, or the $12.8 million account, and why that one fits your goals better. And if you know someone stuck choosing between income and growth, send them this. It might be the 10 minutes that settles the argument for good.